Good day everyone, I'm Mitra, metric number 272567. Today I will present question 1, which is should the following be included in Sneaker 2013 capital budgeting cash flow projection? Why or why not? So for building a factory and purchase or installing of the equipment will be yes, because they are capital uses which are expected to begin tasks consequently. They should be remembered for the Sneakers 2013 capital planning income projection. Next, for research and development costs will be no, because their costs will be also incorporated in calculating the financial projection of the persistent project, as it is a part of this particular project and should be incorporated by the company in estimating future cash flow generated by this particular project. C will be cannibalization of other sneaker sales, which is yes, because cannibalization is a circular impact of the undertaking that might influence the benefits of other business exercise of the firm and happens when deals of new items uproot existing deals. Decrease in deals is a result of capital planning choice and it must be incorporated. Next is interest cost, which is no, because in the capital planning choice, interest cost is commonly excluded. This is on the ground that undertaking ought to be decided all alone and not in how it will be supported. Also, the expenses of capital consider the expected return to both obligation and value holders, so included the interest expenses would bring about two-fold counting of interest costs. E is changes in current asset or current liability account. This is yes, because it's estimating cash flow. The change in the working capital account is deducted from the cash flow after interest and tax expenses. Hence, changes in current asset and current liability account will be subtracted in arriving at cash flow generated by the company. Therefore, the impact of change in current asset and current liabilities account will be rejected in the projection of cash flow generated by the projects. Next is taxes. It's a yes, because the cash flow which are undertaken for the financial projection of the company includes cash flow after taxes. Taxes will be deducted and the final available after tax cash flow will be used in arriving at the future financial projection of the company. Hence, taxes will create impact in estimating future financial projection. For cost of goods sold is yes, because the amount that will be deducted from the revenue arriving at the gross profit margin for the company. Hence, cost of goods sold will be deducted and net cash flow will be used in the financial projection through capital budgeting process. Advertising and promotion expenses will be also yes, because it is related to the operating expenses of the particular project and hence will be deducted from the gross profit of the company in arriving at the net profit margin of the company. Therefore, the deducted of advertising and promotion expenses will be reflected in the future projection of the cash flow expected through the capital budgeting process. Lastly, it's depreciation charges, which is also yes. Devaluation is remembered and deducted as a part of yearly premise, as it diminishes the expense sum. To work out the working incomes, deterioration is added back as it doesn't address a money surge.
Assalamualaikum and a very good morning to Doctor. My name is Dr. Asha binti Kamaruddin. My metric numbers is 267762. Now I will explain about the question 2, which is A. What is the project initial year 0 in investment outlay? So how to get the total initial outlay? Firstly, we add on the factory outlay with the equipment outlay. So we get the answer, which is negative 170 million. Then after we get the answers of the negative 70 million, then we add on the working capital, which is the working capital is inventory increase and account payable increase. Then we get the answer, total initial outlay is negative 180 million. For the question B, what are the projects annual from year 2013 to 2018 for the net operating cash flow? So as you can see in the table, the the total of the revenue is fluctuate, which is from 2013 to 2014, it increased. From 2014 to 2015, it decreased. And from 2015 to 2016, it increased, while from the 2016 to 2018 continuously increased. Get all the total of the revenue, then how to get the earning before tax? The net revenue will minus with the all expenses, and after we got the earning before tax, so to get net income, we have to time with the tax, which is 40%. After we got the total income, we need to add on with the non-cash item, which is depreciation factory and depreciation equipment. So after that, we get the total operating cash flow. So for the 2013 is 10.57 million. For the 2014, 36.79 million. For 2015, 36.41. 2016, 54.818 million. 2017 is 38.95 million. And 2018 is 16.425 million. For the question C, what is the project's terminal 2018 for the non-operating cash flow? Firstly, we need to add on the salvage value, tax on capital gain, and the recapture of the net working capital. After we add on, we got the answer for the terminal cash flow, which is 116,867,500. After that, we must calculate on the tax on capital gain or loss. So when we calculate, we got the capital loss, which is negative 7,350,000, and then we need to calculate with the tax saving, which is 40%, and we got the answer, which is negative 2294,000. For the question D, does nickel 2013 appear viable from a quantitative standpoint? So firstly, we need to calculate the project payback. So when we calculate the payback period, so we get the answer, which is 5.1887 years for the 6 years. Next, we must calculate the net present value. So to get the net present value, we must add all the total discounted cash flow from year 0 to year 6, and we got the answer 133591239. And then after that, we minus with the initial outlay, we got the negative 46408,761 million for the net present value. Lastly, we need to calculate the internal rate of return. We must try at 1% and also for the 2%. For the total discounted cash flow at 1% is 186,468,222 million. While for the 2%, the total of the discounted cash flow is 17995,1191 million. Then after we got the total of the discounted cash flow, after that we need to find the IRR with this formula, and we got the answer, which is 1.99%. The 2013, as we can conclude that Sneaker 2013 does not seem viable from a quantitative standpoint because of the NPV is negative 4,640,8,761 at the end of the year 6, which is less than 0. This is indicate project would result in a net loss 46,408,761 million and will decrease the wealth of the shareholder. Furthermore, the IRR of the Sneakers 2013 is 1.99%, which is less than required rate of the return amounted 11%. Although the payback period of this project would take 5.1887 years, which is the shorter year taken than projected 6 years. It is advisable to not invest in this project as the project would accumulate losses to the company as stated above based on the NPV and IRR calculation. Thank you. That's all from me.
Assalamualaikum, my name is Nur Izzati Amani. My matric number is 272305. I'm going to present regarding persistent question. So for the first question, which is which cash flow should be incorporated into the project forecast. First thing first is 8 million from manufacturing equipment that going to be used in initial outlay calculation. Second is the depreciation that stayed in the question for 3 years, which is 20, 32 and 19, and all of them is in percent. Thirdly is inventory and account receivable, and fourth is design and manufacturing specification, which is 50 million, and it going to be calculated in initial outlay as well as stated in the case study as outside source. And there's a few additional info that is important and will be used on calculation, which is variable cost, advertising cost, general and admin tax rate, and cost of capital. All of these will be used during the calculation, and that has been asked in next slide. So for question 2A, what is the project initial investment outlay? The answer is the initial investment required to start a project are referred to as an initial expenditure. So in order New Balance wants to launch persistent, it will need to buy a new land and machinery to get started. So based on calculation, we get negative 53 million, and this initial outlay will be used to calculate the NPV. For question B, what are the project's annual net operating cash flow? So basically, from this calculation, we can predict the net amount of cash that generate from its operating activities. We started with 350 million and 2013 as the projected shoe market and considered with all costs, depreciation and tax given. And we get the net income. After that, we re-adding the depreciation equipment to get the net operating cash flow. So based on the slide, apparently net operating cash flow for 3 years are positive. So basically, it seems that positive and increasing cash flow from persistent operating activities indicate that the core business activity of the company might thriving and positive. Moving on to question C, what is the project terminal net cash flow? The formula of terminal cash flow is salvage value plus tax on capital gain plus recapture of net working capital. So based on the terminal cash flow that has been calculated, we got 70,320,000. Yet 2013 result for sneakers terminal cash flow are more higher than persistent. So from the net cash flow perspective, the sneakers are much better than persistent. Last question, question 3. Does persistent appear attractive from a quantitative standpoint? So, based on estimation project payback, NPV, and IRR, which is for payback period, we got 2.535, which 2 years and a half for payback period. We got negative 3 million plus for NPV and 10.58% for IRR after we do interpolation. So basically, from quantitative perspective, the persistence not really attractive because the project net present value NPV is negative at the end of year 3. Negative NPV, as we know, we reduce the firm indicative value and reduce the wealth of the shareholder. As we can see here, Persistent also has an IRR 10.85%, which is lower than the required rate of return, which is 40%. So basically, even we got payback period for this project, which is 2.5435 years, 2.5 years, which is less than present limit, it is the best choice to reject it because investing in it will result in negative NPV, net present value.
Now I'll be present on additional question. So for question number 1, which product do you think is risky? How do you should incorporate differences in risk into your analysis? So for persistent, the obvious risk that can be seen in the risk of new products not selling well in the market. Although there is a promising return as hiking and active walking sector are currently one of the fastest growing areas in footwear and thus leading to more revenue and greater advantage for the company to seize the fast-growing shoe trend. There is certain risk to be incurred as New Balance company has never ventured in the segment before. By entering new market segment, there is always a risk of not succeeding in a new product line as there are other current and stable competitors in this segment already. This project can be said to have a small speculation risk as undertaking this project may end up with side uncertainty of loss and gain. For Sneaker 2013, it can be considered having a few risky. This project has relatively higher short-term debt compared to the persistent project. Having higher short-term debts means debt needs to be repaid earlier than equity, thus leading the riskier cash flow. If company has unstable cash flow, this can cause problems as companies need to give priority to repay debts first. Besides, the payback period of Sneakers is no longer by having 5.1887 years compared to persistent, which is only 2.5435 years. Longer payback period induce more risk than shorter ones as they are more uncertain. This is because the longer it takes investment to obtain its cash flow, the riskier that the investment will not make profit. Since Sneaker is another running shoe in the same product line, it reduces sales of existing New Balance shoe compared to persistent, which does not impact sales of other shoe. Thus, there is risk between weighting the cost benefit of undertaking Sneaker shoe, which will impact other sales in company. Thus, it can be considered Sneakers 2013 may have higher risk than persistent project due to having higher cash flow risk and other risks. Next, for question 2, payback period helps to determine how long it takes to get back the cash for initial investment. Both projects have a payback period within their project life which is considered good. However, when compared, Sneakers 2013 have a longer payback period than persistent. Persistent is better than Sneaker 2013 as having a shorter payback period means having investment risk level associated with initial investment cost for only a short time. It is better because a short payback period induces lesser risk and uncertainty. Besides that, both projects provide negative NPV amounts. A desirable investment is an investment with positive NPV. Therefore, both products should be rejected. This is because our goal is to increase the owner wealth and positive NPV helps to add value to the firm. Increasing the owner's wealth. However, since the New Balance help to undertake one if the project's percentage will be a better choice. Although it is negative value, it has a higher NPV compared to Sneakers. Thus, the persistence project is better than Sneakers. Moreover, IRR is the expected rate of return that will be earned on a project. Both projects have IRR lower than required rate of return. However, taking into account IRR value that is closer to required rate of return, persistent is better than Sneaker because it has a closer IRR value of required rate of return, providing a better chance of strong growth. Overall, the persistent project looks better to a New Balance shareholder. For question 3, project must be more critical for the cash flow forecast for persistent than the cash flow forecast for Sneaker 2013. Cash flow forecast determined by every year changes and cash flows in cycle. Rory should be focused on persistent cash flow forecast as it seems more desirable than Sneaker 2013. And for question number 4, the final recommendation is to undertaken the persistent project as it is more desirable than Sneaker 2013. Looking at the financial and investment perspective, Persistent has better performance in terms of capital budgeting techniques, which is IRR, NPV, and payback period than Sneaker 2013. Since NPV is the first priority primary investment criteria, it is important to undertake a project with higher NPV. In this case, we choose Persistent. Besides looking from a market perspective, the Persistent project has lower risk and uncertainty than Sneaker 2013. Since the hiking and active walking shoe is the fastest growing area in footwear and the targeting segment of this project is the 25 to 40 years old category, Persistent can be considered as a suitable perspective to meet the market demands. Besides, taking into account not only younger consumers but also the ultimate purchase, which is the parents, Persistent becomes a better choice than Sneaker 2013. That's all from us. Thank you so much.